Good afternoon, coastal Southern California. Jennifer Tim here, real estate wealth advisor licensed in both Southern California and in the Portland metro Oregon area. We are back. It's 4 o'clock, so it's time for our Where Smart Money Watches the Market, our midweek market brief for coastal Southern California. Let's jump right in. So our national outlook. Let's have a look at the policy headlines and housing dynamics. And there's definitely been a lot of housing related headlines for sure. So Trump proposes limits on institutional home buyers. However, analysts say it would have limited short-term impact on prices or sales if passed, mainly removing a marginal bid, not shifting the core market dynamics. Institutional buyers only own a very small slice of single-family homes nationally, meaning blocking them wouldn't suddenly open the market for first-time buyers. And then policy moves to increase mortgage bond purchases could place modest downward pressure on mortgage rates, but substantial lasting rate relief likely still hinges on broader economic trends. So definitely some things to keep an eye on. Market conditions as we enter in, we're almost halfway through January of 2026. So mortgage rates remain near that sort of 6.2 to 6.3%. Great excitement last Friday. 30-year mortgages, actually, the rate went down below 6. So we saw 5.99 splashed all over everywhere. But again, with every day that passes, there's various reports that come in, headlines that happen, and that impacts the daily mortgage rates. So lower than recent peaks, but still well above pandemic lows. Experts see rates settling in the low 6 range. Home sales climbed in late 2025, with December reporting a notable monthly increase and strongest pace since early 2023. Again, a positive trend. Inventory is slowly rising, but still tight in many markets, a hangover from rate lock-in and constrained new construction. However, we are starting to see that sellers are getting a little more comfortable with the mortgage rates of today and are willing, when they need to, if there's a real reason for them to do so, because of life changes, you name it, ready to sell that house and then take on a higher, more market-related mortgage that's available today. Prices are forecast to grow modestly in 2026. Most estimates range from 1 to 4% nationally, reflecting a slower stabilizing market. Again, not a bad thing. Affordability and demand signals. Affordability is improving gradually thanks to slower price growth and slight rate easing, but remains a barrier for many first-time buyers. Pending sales and mortgage application volume are rising as buyers respond to slightly better conditions, though still shy of a full rebound. It's all about affordability. Construction and housing starts remain below long-term trends, meaning supply shortages won't disappear quickly, even if demand ticks up. So what this means for 2026 at that national level, slow and steady improvement. Analysts expect home sales and prices to edge higher without dramatic swings. A more balanced, normalized market compared with recent volatility. Mortgage lock-in is easing, as I mentioned. More homeowners are now subject to current market rates, reducing the inventory restraint that plagued markets when ultra-low locked interests dominated. Policy may matter more psychologically than materially. Even headline-only proposals can influence sentiment and participation, but supply constraints, affordability, and rate direction remain the core drivers of 2026 activity. So speaking of mortgage rates, the rate from Mortgage News Daily today, published this afternoon, the average was 6.07% for a 30-year fix. A 15-year fix, we're looking at 5.58%. Jumbos, of course, are a little higher. And then VA is a little lower as well. So Mortgage rates unchanged despite bond market improvement was their headline. So trading levels in the bond market directly impact the rates that mortgage lenders can offer. This is why rates moved so much lower after last week's news regarding planned purchases of $2 billion in mortgage-backed bonds. But bonds aren't the only input for rates, and those other inputs can make for days like today where bonds are noticeably better while mortgage rates refuse to follow. And of course, there's more information for you to read at your leisure. And of course, if you go to their website, they have even more information there. So our smart money insight at the national level, 2026 looks less like a boom year and more like a reset. Rates stabilizing, inventory slowly rising, and affordability inching forward. So smart money participants will act on data, not headlines. So important, I should have put that in bold. Policy noise can change sentiment quickly, but long-term value is built by understanding fundamentals like rates, supply, demand, and local market strength. We're all about a boring market this year. So our local market spotlight, Capistrano Beach, our market action index has gone down slightly. It's now sitting at 32. Median list price just under 4 million. Price per square foot, 1,101. Inventory of 17 homes on the market, and median days on market 98. So basically very little activity that has happened in the Capistrano market. So cooling but not broken. The MAI has slipped from 34 to 32, signaling softer demand, but still a seller's advantage. Longer hold times, 105 days on market, suggest buyers are patient and pricing discipline matters more than ever. Luxury micro market reality with inventory at just 17 homes. Quality coastal assets will still command attention, but only if priced to today's reality, not yesterday's peak. Smart move, buyers gain leverage on price and terms, sellers must lead with strategy, not hope. Very sound advice there. Moving on to Dana Point. We have had a little bit of activity here now. Market action index has gone up slightly to 36. The median list price has gone up. It's now just under 6.5 million. Price per square foot is down 1,715. Inventory of 27 homes has gone down. Median days on market 81. So plateau at the top. Prices have stabilized while the MAI holds steady at 36. A classic pause before the next move. Premium assets still win. Trophy properties continue to attract qualified buyers despite longer days on market. Market favors preparation. Sellers who invest in positioning will outperform those who test the market. We've talked about that before. Investor lens, watch that MAI closely. Sustained strength could reignite upward pricing later in 2026. San Clemente, our slight seller's advantage of 43 remains unchanged. Our median list price slightly down to 2.35 million. Price per square foot slightly up, 925. Inventory up slightly, 47 homes, and our median days on market unchanged at 91. So our smart money insight, momentum building, MAI rising, 243 confirmed stronger absorption and upward pricing pressure. The demand supply inventory at 47 keeps competition alive, especially for well-located homes. Rent versus buy gap, high median rents, around about that 7,200 a month, continue pushing qualified renters into ownership. Strategic takeaway, this is one of the coastal markets showing early cycle strength heading into spring. And San Juan Capistrano, still our strong sellers market, slightly down with that MAI of 51. Median list price slightly down, 2.7 million. Price per square foot unchanged at 772. Inventories up to 24 homes. Median days on market is up to 53. So a strong sellers market intact. The MAI at 51 keeps pricing power firmly with sellers despite a slight dip. Severely constrained inventory, as we mentioned, only 24 homes, limits the buyer options and supports long-term values. Shorter days on market reflects decisive buyers. Hesitation can mean missed opportunities. Smart play buyers must be strategic. Sellers should strike while the market velocity remains high. So keep an eye out for some information on about some of the other markets that we follow. And our global perspective, we keep coming back to this, but international buyers are returning to the US housing market with a sharp eye on lifestyle stability and long-term wealth preservation. The strength of US dollar, high quality assets, and global uncertainty are pushing more capital into US real estate. Again, there was a little lull and now it's returning. Whether it's coastal California, urban Portland, or luxury second homes, real estate continues to be viewed as a safe haven by global investors. So our smart money insight is definitely continue to think global, act strategic. And as a certified international property specialist, and because I'm part of Keller Williams' huge global network of agents, I can connect clients to trusted resources across borders, from real estate agents to attorneys, etc. If you are thinking of acquiring or liquidating an overseas asset, definitely reach out because I can help you. Our wealth building insight, plan, protect, and prosper. So real estate is not just where you live, it's how you build wealth. Whether you own one property or several, now is the time to take a proactive look at your portfolio. So here's what smart wealth builders are doing right now. They're creating a real estate plan aligned with their financial goals and timeline. This is the perfect time to do it as we're entering the stage of a stronger market, which is, yes, boring, but it's moving, and that's what we're looking for. It's not out of control. Requesting an equity analysis to understand the true value of their holdings, and of course we can help you with that. Realigning insurance coverage to match current market values, especially as property values shift. We discussed that last week. And strategizing for Q1 and Q2 moves. Refinance, upgrade, invest, or hold. As your trusted real estate wealth advisor, I'm here to help you with your property planning, your equity snapshot, and to connect you with financial, legal, or tax pros as needed. And we work with your team to make sure that we're supporting your goals. So let's schedule your 2026 wealth check-in, your future self. Well, thank you. And it's all about talking strategy. So if there's anything from today's brief that you had questions about, or you're inspired to take a next step, I'd love to connect with you. This is the best way to reach me. And just that final reminder that we do provide this material for general information purposes only. I am not an attorney. I am not a CPA or a financial advisor. So we have obtained the information from credible sources, but it is really important for you. If you're going to move forward with anything, we're going to work together with you and your financial and legal team to make sure that you are able to achieve your goals. And with that, thank you so much for joining us on this Wednesday afternoon, the second one in January. And I look forward to seeing you next week.